We will continue our section 1 and focus on 1.3 fund lifecycle legal structures and compliance in this video. We will have 5 main topics: lifecycle, key document, legal structures, jurisdiction, and regulatory. A typical private equity fund goes through several distinct stages. We will have formation, investment period, holding period, and exiting period. This initial stage involves creating the partnership, formulating the investment strategy, and raising capital. This phase can last anywhere from a few months to over a year, depending on market conditions and the GP's track record. Once the fund closes, it enters the investment period. During this time, the GP identifies and executes investment opportunities, issuing capital calls to LPs as needed. This period typically lasts 1 to 3 years but can extend longer for some strategies. After investments are made, the fund enters the holding period. This is where the real work of value creation happens. GPs work closely with portfolio companies to implement strategic initiatives, operational improvement, and growth strategies. The holding period usually lasts 3 to 5 years, but it can vary based on the fund's strategy and market conditions. As the fund matures, it begins to exit its investment. This can happen through various means, such as selling to strategic buyers, other private equity firms, or through initial public offerings or IPOs. The proceeds from these exits are distributed to LPs, hopefully at a significant profit. This phase also involves winding down the fund, settling any remaining obligations, and ensuring all legal and financial matters are solved. So this is J curve to illustrate a fund life cycle. In terms of different type of funds, these are the different stages they will focus on. So what are the key documents? There are limited partnership agreement, LPA, private placement memorandum, PPM. So these are like Bibles of the funds. Subscription agreement, site letters, and financial statement. They may name it differently, but basically just the balance sheet, income statement, change of partners capital, and the cash flow statement, SOI, and the note of financial statement. And then we will have a capital account statement and then other documents. So the documents form the core of private equity fund accounting and reporting, providing transparency and compliance with accounting standards such as GAAP or IFRS. Now we're going to dig into the details of the key fund document, LPA, PPM, and a subscription agreement. LPA serves as the primary governing document for the funds. It outlines the rights and obligation of general partners and the limited partners, and details and fund structures, investment strategies, and operational procedures, include provisions on capital calls, distributions, and fund governance. In terms of a PPM, it offers comprehensive information about the fund to potential investors. PPM describe investment strategy, risks, and potential returns. Subscription document allows investors to formally commit capital to the fund. When fund decide the legal structure, there are two typical legal structures: limited partnership or LP, limited liability company or LLC. LP is the most common structure for private equity funds. It provides limited liability for investors and a tax benefit. LLC is another popular structure offering similar benefits to LPs, and it has been growing popularity. In terms of a jurisdiction, the choice of jurisdiction can significantly impact a fund's regulatory environment, tax treatment, and investor appeal. So for onshore, it's preferred for its business-friendly laws and established a legal precedent. It offers a well-understood regulatory environment for the U.S. investors. Offshore, there are a few popular jurisdictions such as Cayman Islands, British Virgin Islands, Luxembourg, and the United Kingdom. They each have their unique advantages. Private equity funds are subject to regulation in various ways depending on the jurisdiction. Here are some key regulatory bodies and frameworks that oversee private equity funds in major regions. For example, United States Securities and Exchange Commission, or SEC. The SEC regulates private equity funds under the Investment Advisor Act of 1940. Funds must register with the SEC if they have more than $150 million in asset under management, although there are exemptions and exceptions. Financial Industry Regulatory Authority, or FINRA. While FINRA primarily oversees broker-dealers, it can have some influence on private equity transactions and interactions with public market. And then also we have New York Stock Exchange and the state administrators. They both regulate the private equity funds. In Europe, we have Alternative Investment Fund Management Directive, or AIFMD. Last but not least, we're going to talk about the trend. In recent years, there are some evolving trends in private equity, such as ESG, big data analytics, AI investment decisions, digitalization, transparency issues, and also have some sector specialization. So these are some popular trends you probably will hear a lot in this industry.